Good morning, everyone, and welcome to another monthly webinar. Now, this morning I'm joined by two industry experts, Elmien Wagenaar and Wiehan Dul. As per the invite, you would have seen that we are talking about living annuities this morning, and we will try and see if we can unravel the living annuity conundrum. Firstly, you may wonder what exactly that conundrum is. Well, it is probably a culmination of various things. One of these issues remain longevity. We saw Stats SA release data showing that in 2022, we had the eldest population in our history. And given medicine and science, people do tend to live longer. Well, then there's also the issue of not saving enough and also potentially people retiring too early. Another socioeconomic issue is the fact that more and more South Africans seem to provide for other family members, such as elderly parents, and then their own children, placing more of a burden on their financial situation. Now, South African retirees had 625.9 billion rand of their retirement savings invested in living annuities at the end of 2022, which marks an increase of 47% according to ASISA. In the 5 years since ASISA published the 2017 living annuity stats, the average living annuity drawdown rate has consistently stayed below 7%. But in 2011, if you go back a bit earlier, there were numbers published where they showed that the average drawdown rate was 6.99%, which was then the highest ever recorded. Jaco van Tonder, Sales Director at 91 Investment Asset Management and Deputy Chair of the ASISA Marketing and Distributions Board Committee, also notes that annual drawdown rates of 4 to 5% in the first decade of retirement does seem to be much more prudent. And generally, if you can keep your drawdown rates in the latter part below 8%, it actually also assists the portfolio. But these are some of the conundrum, or this all forms part of the conundrum. High withdrawal rates, socioeconomic burdens, longevity factors. But then we ask ourselves, could there potentially be investment-related questions and issues that we can address? Can we perhaps, to a certain extent, address some of these concerns by introducing alternative investments? I'm going to go over to my second screen now. So just to be joined by, as I mentioned, an industry expert in her own right. She's from Think Capital. Welcome this morning, Elmien Wagenaar on the call. Elmien, thanks so much for joining us this morning in what seems to be a difficult topic. On paper, sometimes it seems much easier to implement some of these points that we might discuss. But let's first talk about the real burden of living annuities. You wrote an article on the real burden of living annuities a while ago, and how the appropriate combination of hedge funds could perhaps help carry the load. What were you referring to in this article as the burden?
Thank you, Tanya. So yes, you framed it very well in your introduction. That the burden of the living annuity is that massive responsibility placed on it because of where it is in the life stage of the client. So it's a post-retirement product that aims to provide an income to the family for the duration of their retirement years. And the overarching risk event that should be avoided is that the investment cannot provide sufficient income for the required duration, and by implication that the client will have to lower their standards of living. So in a typical risk assessment matrix, the likelihood of an event is plotted against the severity of the impact if that event would take place, and then a risk is assigned. So for the risk of having to lower the standard of living, one would say that even when the likelihood of this risk event is low, the potential impact for the client of this risk event is severe, and therefore the risk should be considered and managed regardless of its likelihood. So added to this, the likelihood of an investment not able to provide sufficient income is higher than most think, because there are multiple risks that can very quickly hijack the health of a living annuity. So as you mentioned, the starting value is too low, life expectancy is too high, the initial withdrawal rate is too high, the withdrawal rate escalation is too high, the investment growth rate is too low, the sequence of returns of the investment is unfavorable. And all of these risks need to be managed throughout, not just once off. And really a very delicate balance of all these variables is needed to keep a living annuity stable. And in short, the burden of most living annuities is that there is very little room for error before the standard of living of the client is impacted. And it's especially with the last two risks, the sequence of return risk and the risk of low investment growth, where I believe that hedge funds can really play a role. And what I hope that we can achieve today is to show that these are two distinct risks for a living annuity, and certain hedge funds can be combined to stabilize the living annuity for sequence of returns risk, and others can be used to support higher growth. But hedge funds are actually very diverse, and the same hedge funds are not necessarily equally well suited for carrying both loads.
I'm glad you actually referred to that because Amity really subscribes to this view of that you need to ensure suitability of investments, and you've touched on it now. But in your article, you also mentioned that traditionally hedge funds were not considered a viable component in a living annuity. Now, given this article has been written some time ago, is this statement still valid? Or have you perhaps seen now a shift in the industry where more hedge funds are being used within the living annuity space?
Yes, frustratingly, hedge funds needed to overcome several challenges to step into that essential role of stabilizer or return generator in a living annuity. So initially, hedge funds were deemed a viable asset to protect investor capital in pension funds by Regulation 28. And it was also allowed in living annuities by the Long-Term Insurance Act. But hedge funds could not be marketed to the wider public. So mostly institutional and high net worth portfolios benefited from them. But this changed when hedge funds became regulated as collective investment schemes in 2015. Both institutional and retail investors were then allowed to invest in hedge funds. And most importantly, we were allowed to market hedge funds, which meant that it was easier to educate investors and dispel many of the misconceptions. But then hedge funds had to be put on the list platforms for those living annuities needing it most to get access to that. And it took a while, but that is also now behind us. So in my mind, now the final step for most living annuities to benefit from hedge funds is for advisors to make sure that they match the right combination of hedge funds with a distinct risk to achieve the desired results.
Refer to another article by 91 Asset Management where they state, and I want to quote this, volatility is a core factor to consider in living annuity investments. Now, firstly, when we had our session last year with you and some of the other hedge fund managers, we actually wanted to bust some of these myths, right? We said that, for instance, not all hedge funds are risky. That's one thing we've mentioned. And the thing is that it's so counterintuitive sometimes. You think about hedge funds and you think about risk, and you cannot really think, how can you align this with a living annuity client? So bringing it back to maybe my question then, what is the impact of a hedge fund on the volatility of a living annuity portfolio?
Yes, I think to answer that question well is firstly to refer to that 91 study that was very comprehensive and done a few years ago, where they looked at the relationship between real returns, volatility, and sustainable income levels for living annuities. And they found that for most living annuities, there were two ways of ensuring more sustainable income. The first way was that for every 1% additional real return produced by the investment, the pensioner could receive around 0.9% per annum of additional sustainable income. And the second way was for every 1% reduction in volatility of the investment, the pensioner could receive an additional 0.3% per annum of sustainable income. In other words, the portfolios will not erode if you can get that balance right. And about the volatility, they specifically said that understanding the impact of it helped them quantify the value added by an active manager who is able to produce lower risk portfolios without sacrificing real returns. The study was done in long-only space. But it must be true that if a hedge fund can significantly lower volatility without giving up potential real returns, or if a hedge fund can add additional real returns, they must add value to living annuities in line with the 91 study. So, as you mentioned, it is true that not all hedge funds are risky, but in reality, they are very diverse, and there are good hedge funds that take on more risk. More risk does not make them bad hedge funds. But if we bring it back to the 91 study, it might mean that some good hedge funds are not well suited to reduce volatility. But maybe they can be used to add real returns, or some may not be suited to a living annuity at all. So let's look at the following graph for more clarity. The graph shows the risk and return characteristics of all the ASISA multi-asset high equity funds in orange over the past 5 years to the end of May 2024. I also add the risk and return of the JSE All Share Index and the All Bond Index just as reference points. Let's think of these traditional funds as the basis of a living annuity. Then we add all the South African hedge funds over the same period. The blue circle is the Think Capital combination of hedge funds after all fees. So this is quite an interesting graph, I think. It is clear that not all hedge funds had volatilities lower than balanced funds, but many had and therefore could have added value. Others may not have reduced volatility, but they may have added additional real returns, which is also useful to a living annuity. But the same funds did not deliver both. I want to specifically then also highlight fixed income hedge funds in this graph. In long-only world, fixed income funds are generally accepted to reduce volatility. And it may be assumed that this is the same in hedge fund world, but it is not. And it is important to understand this with regards to living annuities. Especially when considering a living annuity, it should be noted that there are two subsets of fixed income hedge fund styles: conservative styles and more aggressive styles. They are brilliant funds following the aggressive styles, but they will not necessarily dampen the volatility of the living annuity if that is what is required.
Now, even if there's not a case for all hedge funds in living annuities, is there then evidence to perhaps show that it positively impacts volatility and, more importantly for us, perhaps the sequence risk when you consider adding some hedge funds?
Yeah, I think it is definitely worth sharing our own evidence in pictures to show the substantial impact that the sequence of returns have on a withdrawing portfolio, firstly, and then more specifically to show that certain hedge funds are better suited to managing this sequence of return risk of living annuities than others. So to start off with, see the cumulative growth of the actual combination of hedge funds after all fees that I have been involved with over the past 21.5 years. It includes all my good decisions, all my bad decisions, timing issues, funds available at those times, and investing without foresight. And I see this as the fairest way of representing historical hedge fund returns for a certain profile, rather than choosing some with perfect hindsight now and backtesting their returns. So we assume that no income is withdrawn from this investment. Then we add to it the growth of an investment in the JSE All Share Index, SA bonds, and then of the largest balanced fund in South Africa, also without any income withdrawn. For the next part of the study, and this is maybe a little bit complicated, we then change the sequence of returns of all of these investments to incur their largest negative months first and their largest positive months last. I did not change any of the actual monthly returns. All I did was rank them from lowest to highest and assumed that all the returns of the investment occurred in that new order. So the dotted lines are the cumulative results of the new order of returns for each of the investments. first the value of the investment goes down because all the negative returns is at the front end, and then it recovers due to all positive returns coming then. What is important to note here is that the values of the reshuffled sequence of returns and the actual sequence of returns end up at exactly the same point. It means that for the client who invested 21 years ago and had no income needs, it made absolutely no difference whether all of the negative returns came first and then all the positive ones, or whether positive and negative returns alternated. But then let's look at the picture when these investments enter the living annuity space, with the client drawing an initial income of 4% and an annual income escalation of 5%. The ending values are now lower, but still above the initial 5 million invested. So the graph shows that all four investments would have supported the living annuity sufficiently to deliver the desired income and still grow. It may also seem that over the 21 years after withdrawals, the graph does not provide any overwhelming reason for the use of the hedge fund combination versus the traditional balanced fund. But a very different picture emerges if the sequence of returns change and the different portfolios encountered their losses first and then have had to make withdrawals. If that would have happened, the JSE would have depleted capital in 4 years, the largest balanced fund in South Africa in 7 years, bonds in 7 years and 9 months, and the hedge fund combination in 11 and a half years. Now, this is an extreme scenario and very unlikely to happen, but what it clearly shows is that the losses of the JSE, bonds, and the largest balanced fund eroded capital when providing income, and the investments relied significantly more on the positive returns to sustain the withdrawals of the living annuity, as we saw in the previous slide. It means that if the sequence of returns over the last 21 years for the balanced fund is used as the base case, any shift to a few more negative months in a row for the balanced fund will affect the living annuity more. And it also means that the hedge fund combination is a much more appropriate way to manage a sequence of return risk.
So what is the main difference, Elmien, then between the combination of hedge funds and the typical balanced fund that makes such a difference in the longevity?
Yeah, so firstly, the volatility of the hedge fund combination is designed to be lower and therefore makes a difference to the sustainability in line with the 91 findings. But secondly, there's actually another compelling difference in the structure of the volatility. So the next graph shows the rolling 12-month volatilities of that largest balanced fund and the hedge fund combination. It shows that the volatility of the balanced fund is not stable. It spikes. And it's in those spikes that capital gets eroded more by withdrawals. And then thirdly, if we break the cumulative return up into combination of negative months and positive months for the balanced fund, and then check what the hedge fund combination did over the same periods, the hedge fund combination protected capital much better and then participated only sufficiently to end up with the same outcome. This is what the Think Capital strategy is designed to achieve, and that is the value that it brings to a living annuity.
Very important aspect of this. Can you add too much or too little? I mean, is there an optimal allocation if an advisor were to consider adding hedge funds to living annuities? I mean, it seems like with everything in life, sometimes too much of a good thing is also not good. But what would be your take on if someone were to ask you whether there's an optimal allocation of hedge funds?
I would say to that advisor, I think if you have 0 hedge funds in the living annuities, then you have too little. But it is also important to say that having the right hedge funds in your portfolio to bring it back to managing both sequence of return risk and growth risk. And to illustrate that, I'm going to show the same study that I've done just now for the balanced fund for for a well-known large single strategy hedge fund with an amazing 25-year track record. So if we assess that fund in the same way for its sequence of return risk, the following transpires. The volatility of the large single strategy hedge fund over the last 21 years was in line with that of the balanced fund, but the returns were quite a bit higher. If we look at the rolling volatilities, the volatility of the largest hedge fund is also quite variable, and it also spikes just like the balanced fund. And therefore, it should not come as a surprise that the sequence of return risk is not managed that well by the large single strategy hedge fund. It is managed slightly better than the balanced fund would, but also for this single strategy fund, the support of withdrawals came more from the positive returns than from predicting on the downside. So just to drive this point of two risks and two solutions home, the graph shows the outcome over the last 10 years after withdrawals of all the investments considered today. The large single strategy hedge fund I showed not to do that well in the sequence of return risk assessment added significant value through higher real returns. And the lower risk thin combination of hedge funds added value through stabilizing the portfolio for income withdrawals. So both the 91 benefits would have been achieved through the use of these two different selections. So to answer, if you only have return generating hedge funds and no stabilizing hedge funds in your living annuity, your sequence of return risk is still not managed well. Both these risks can and must be managed, and it demands different hedge funds for it. So, but if the advisor pushes me for a number, I would say that you will not go wrong with a 50-50 allocation between stabilizer and return generating hedge funds, and a 20% allocation to the right hedge funds in the living annuity will add value.
Now, in a very recent webinar we hosted on income funds, and it was specifically around the fixed interest space, we had discussions on the relevance of doing a proper due diligence. Now, for income funds, there seems to be a bit of a challenge because disclosure documents seem to not always show all the relevant info, and there's a lot of jargon and technical know-how of the income funds. But now, if there's an advisor on this call who might not want to deal with a DFM to help them with due diligence, you as an allocator of hedge funds, you surely know how important doing a proper due diligence is, especially in this hedge fund manager space. You know, asking the right questions for hedge funds, knowing which combination of hedge funds to blend. What are some of the pertinent questions, and how should advisors consider them to compare hedge funds with one another?
I think the first bit of advice that I would give is that the advisor should not derive their view of risk by looking at the underlying asset class that the hedge fund invests in. A fixed income hedge fund can have risk in line with equities, and an equity hedge fund can have risk lower than bonds. So each fund must be assessed on its own strategy. And then in due diligence, think Capital broadly views risk as L squared plus C cubed. So the two L's are leverage and liquidity, and the C's are correlation, concentration, and complexity. But these are not standalone risks. In hedge funds, risk is in the combination. You can have high leverage in a portfolio that has positions that are diverse and not correlated to each other or to the market. That does not necessarily result in high risk. But if they have high leverage in a concentrated, illiquid portfolio, it might be a different story. Or maybe they have low leverage and higher correlation to the market. That may be fine too. So it's the balance of these factors that create the risk and return. And unfortunately, in hedge funds, that changes quite a lot. Depending on market conditions. So it needs to be understood and constantly monitored for change.
Elmien, As always, it's such a pleasure to have you on our webinars. You bring so much insight to this topic, and I really want to thank you from Amity's side. Thank you for agreeing to meet with us this morning. Ladies and gentlemen, I'm going to switch over now and ask Wiehan Dul from Amity Investment Solutions to share with us a bit more about his findings.
So we just had Elmien on the first section of this webinar, and as I mentioned, now joining me is Wiehan Dul. He's an investment analyst at Amity Investment Solutions, and probably no stranger to some of our associates on the call. So Wiehan, you have done some extensive research as part of the investment team at Amity, specifically on this topic of like factors such as longevity risk and sequence risk, and overall just looking whether it's possible to build certain decumulation portfolios. So I thought to incorporate your research that you've done, some of the findings perhaps in this section today, and I think it addresses some of the stuff that we've chatted, Elmien and myself just now, on hedge funds as well. But if you could maybe start us off this morning with the accounting for risk. If I were to ask you whether you can maybe share with us, is there a difference between something like longevity risk and ruin probability? How do you define it? What is, for instance, sequence risk when you look at it? So maybe start with that if you don't mind.
Okay, well, let's start by qualifying what's longevity risk, all right? So longevity risk refers to the possibility that a retiree will outlive their retirement savings, okay? So longevity risk adds a layer of uncertainty regarding the optimal parameters with which to form a retirement plan, okay? Now, we can minimize the uncertainty around longevity risk by increasing the decumulation horizon in a client's retirement plan. So let's say from 30 to 35 or 40 years. Okay, but what we'll find is that this generally requires an adjustment in either the initial withdrawal rate or the escalation rate. All right. So let's assume escalation rate needs to be in line with expected inflation to maintain a client's consumption patterns. So we don't want to change that. All right. What we're left with is the initial withdrawal rate. So the initial withdrawal rate can substantially improve or impair a client's outcomes. And really what this refers to is if a client is expected to live for 35 years, but they were to instead live for 40 years, this would be longevity risk. They're outliving the expected decumulation horizon that's outlined in the financial plan. And really what we want to do to minimizing longevity risk is then say, well, let's plan for extra few years, just to make sure that we know that there is a backup or a buffer if you were to live past that horizon. All right. The next thing to consider then would be sequence risk. So sequence risk refers to the danger that the order or timing of investment returns can negatively impact the value of a client's living annuity. We like to think of sequence risk as the probability of experiencing sizable drawdowns throughout the horizon. So over a 35-year investment horizon, what is the probability of different maximum drawdowns? And obviously, if we can minimize the probability of large drawdowns, we can generally account for some level of sequence risk. All right. And generally, sequence risk can be reduced by effective diversification. So in the form of either improving the portfolio's return profile or reducing risk, right? And that's really where hedge funds come in. They're now an alternative strategy you can add. And by including them, you could choose either I could increase or enhance my return, reduce my risk, or you could do something in between, right? Reduce risk while enhancing the return profile. And hopefully what that will do is it will reduce the sequence risk of a client's portfolio through time, because as the different diversified allocations move sort of against each other, but obviously with a positive drift through time, this should try or essentially, reduce that sequence risk through time. I think a nice way to sort of measure this or quantify this is to consider ruin probabilities. So a ruin probability refers to the probability that a retirement or a retiree's living annuity will be depleted before the end of the decumulation horizon. So what's the probability value I can put on that scenario happening? Okay. We like to calculate ruin probabilities by simulating millions of cash flows, and then we aggregate the number of portfolio sequences that fail to sustain a positive balance at every point in time. And really what this does is it helps to quantify both the effects of longevity and sequence risk throughout your decumulation horizon.
And And maybe then for some of the newer advisors or some of prospects or so on the call this morning, we have a range of model portfolios, and the guarded growth and the balanced income so often in that same a CISA category, same CPI plus target, same investment horizon, a rolling investment period, might seem like, why would you have a guarded growth and a balanced income? And maybe that's also then a very important point, is that within the balanced income, that's where you specifically now have included the ruin probability as one of those statistics there.
Yes, I think what's important to qualify there is that when you're looking at guarded growth, yes, we are trying to minimize a certain level of risk, but we're also trying to add upside potential, right? With balanced income, we see it a little bit differently. We're much more cognizant of those tail risks through time than we would be for guarded growth. Obviously, we also want some upside potential, but because we look at the levers a little bit differently, it means that eventually their target allocations will be slightly different because they will have different goals through time.
Yes. So that then answers it in a sense to say that balanced income would be very suitable in a decumulation phase, where guarded growth potentially still ideal for your saving in an RA as it's a Reg 28 portfolio, for instance, in that sense. Perfect. So, but if we take now what you've mentioned here from the accounting for risks, if I were to add a hedge fund, for instance, Elmien shared some interesting insight into, what it does to the volatility of a portfolio. But from a pure efficient frontier, I mean, this is one of the first, I would say, if you get exposed to the industry, when you start, efficient frontiers would be the first thing that where you start to see risk and return measures. So what does it do if you look at a typical efficient frontier? What does including a hedge fund actually bring to the table?
So let's assume we create efficient frontier using multiple traditional long-only assets, so local and foreign equities, fixed income, property, for example. What you'd find is you have your whole efficient frontier, and then let's assume you were to add hedge funds. Let's assume you would only like to add a maximum of 20%. Okay. What happens is your entire curve shifts up and to the left, which means you get a higher return per unit risk. Okay. So what I've done here is I said, well, let's set up a number of scenarios to help explain how we might go about constructing a living annuity portfolio and how the inclusion of hedge funds might enhance that. All right. So I've considered two efficient frontiers. You have the one including only traditional long assets and another including hedge funds. Okay, the long only curve is then constrained, of course. So it's unconstrained, and then the blue curve, the one including hedge funds, is then constrained just to the 20% maximum. The first thing, you can see I've considered three scenarios. Okay, scenario A is a portfolio on the center of the long only curve, which gives us a return of about 11.3% annualized with a volatility of 6.3. Okay, this is just arbitrary. If you just pick a point, it's just for the purposes of explaining the scenarios we're building through. Okay. Scenario B is a portfolio on the second curve, which is directly above point A, and this gives us a return of 12% annualized with a volatility of 6.3. So we've kept the risk constant and opted for just increasing the return. All right. Scenario C is a portfolio on the second curve, directly to the left of point A, which gives us a return of 11.3, so the same as scenario A, but now we have a volatility of 5%. So we've kept the return constant relative to A, but we've adopted or opted to decrease the risk. Okay, now we have three portfolios to compare. One excluding hedge funds and two including hedge funds. And really, if you take the triangle between those points, you have A, B, C. If you look at the entire area in that triangle, that is an efficiency gain from point A. So assuming point A was your initial efficient portfolio, you wanted to enhance that portfolio, everything in that triangle would be an efficiency gain from that perspective. Okay, so we essentially unlock a new set of return per unit risk, a new set of possibilities for that. And that's really what alternatives give us and what the hedge funds can give us in this scenario. All right. So we have a plot representing the maximum drawdown probability distributions for all three of our portfolios. Okay, we construct these distributions similarly to that of the ruin probabilities. But what we've done here is we calculate the maximum drawdown of every simulated return sequence over a period of 35 years. which is the simulated decumulation horizon for these scenarios. And this leaves us with probabilistic distributions from which we can quantify each portfolio's expected risk. Okay. Portfolio A would be in red. This is the highest expected maximum drawdowns from each of our portfolios. Okay. Portfolio B has a lower expected maximum drawdown relative to A, and that's the orange curve, but it's still riskier than C. Okay, so by enhancing the return from A to B, we've constructed the orange curve, which has certainly reduced our expected risk. Okay, but by holding the return constant and decreasing volatility, we've constructed the blue curve. Okay, portfolio C, which has the lowest expected drawdowns and which should be expected, right? Because we know we've just tried to aim at reducing the risk. So now what we see in this graph is at the x-axis we have the maximum drawdown, and now you have the distribution of all expected drawdowns. And what you'll find is, let's say you go pick those three portfolios off the curve and you look at their historical maximum drawdown, they would all fit in this distribution. They would likely be on the far end because the drawdowns we've experienced either through the GFC or through COVID are really once-off shock or market uncertainty events that lead to large drawdowns but have a low probability of occurring through time. So these distributions say over 35 years, here is the range of expected maximum drawdowns that these portfolios have. And by doing this, we can quantify how have we adjusted the risk profile by adding alternative investments.
So this is very interesting when you now start to talk a bit about the drawdowns, and I'm thinking of a client withdrawing from a living annuity portfolio. So as a statistic, and I mentioned this up front when when Elmien and I started the conversation, is that according to CISA, the average drawdown rate was 6.99% in 2011, which was the highest ever recorded. It has, since they've started measuring this in 2017, CISA has found that it has never breached 7%. The average has never been more than 7% of withdrawal rates for clients. But also that when I read through this, and I mentioned this to the audience, is that Jaco van Tonder, that from 91, who also sits on that board for CISA, his idea is that a safe withdrawal rate is 4 to 5%, especially in your first decade, perhaps, of retirement. And maybe after that decade, you could consider having a higher withdrawal rate. Considering what Jaco has written in this piece and considering the CISA stats, some of the research that you perhaps have done, do you think there is something like a safe withdrawal rate? Is it something we see? And also, is there perhaps a myth that as soon as you increase now, let's say hedge funds, you could just increase your withdrawal rate and you will be fine? Or what is the findings been?
Well, certainly there are a group of safe withdrawal rates, and yes, 4 to 5 typically is those. 6% withdrawal rate can work in certain instances, and let me show you why here. So what I have here is a plot of the cumulative ruin probabilities through time, and this is excluding hedge funds. So on your x-axis, you have the number of years, and we've cut it at 35, okay? On your y-axis, you have the cumulative probability of ruin. So what's the probability that a client's balance goes to 0 at any given point in time? Okay. What we see is I have a number of initial withdrawal rates. Remember, we stick to a 5% fixed escalation. And what we see is that the 8% withdrawal rate is not going to make it, right? You have an 86% chance of ruin. And you can see really the inflection point is roughly close to 15 years. So 8% withdrawal rate will not cut it. Similarly, with the 7, over 35 years, it has a 60.5% ruin probability and also inflects near, let's say, to 18 years. Okay. 6% sits at about 25, 26. So clearly that's not reasonable. It's not a safe withdrawal rate for your client to be using. But if you look at the 4 and 5, those are very, very close to 0 at the 35 mark. So surely those are more reasonable withdrawal rates. We must remember then, if you increase the horizon, this is where longevity risk comes in. If you increase the horizon, these curves will eventually tilt up as well. They will also inflect. So, the longer the horizon, the lower the initial withdrawal rate would really need to be. But now let's consider if you were to add in some alternatives, how that might affect these ruin probabilities through time. And maybe we find that some other initial withdrawal rates become more reasonable. All right. So what we have here is including hedge funds, but the low risk. So before we looked at scenario A, now we're looking at scenario C. So this is actually scenario C. So we've just kept the return constant and reduced the risk. And what you see is for 8% withdrawal, it's actually slightly worse. All right. Remember, volatility explains deviation positively and negatively from the mean. So sometimes at a certain rate of return, volatility can actually help you. It's the old adage, you take more risk to get more return, right? So in this instant, reducing your volatility has reduced your upside potential. So at 8% withdrawal, you're actually worse off. Okay. At a 7% withdrawal, it's basically the same. Your ruin probability is about 60% in 35 years. But the 6% withdrawal rate has now gone from 26 to 18.4 in terms of the ruin probability. So reducing your risk by including hedge funds has helped you at a 6% withdrawal. Similarly for a 4 and 5. For those three withdrawal rates, you've actually improved on the results. So that's great. Obviously, if we can hit a 6 and you say the average is about 6.6 at the moment, clearly adding hedge funds or alternative investments can help those kinds of clients to sustain a more reasonable withdrawal rate. Now let's consider if we were to simply enhance return. All right. Now what you find is all the ruin probabilities have fallen. Okay. So for an 8% initial withdrawal, your ruin probability at 35 years is now 74.5. For a 7% withdrawal, we're sitting at 43. For a 6% withdrawal, we're at 13.5. So certainly much, much better, right? All the way from a 26 to a 13.5. This becomes more reasonable. Your 4 and your 5 are obviously still very, very safe. But we think anything sub 10% on a ruin is a decent or reasonable withdrawal rate, given it does not account for any tactical tilts through time. So obviously what we would do in managing this kind of portfolio is we would set up an expected return range 12 months ahead, via capital market assumptions and factor modeling. And we would go say, okay, what is the distribution of expected returns in the next 12 months? And we can go and reduce that tail as much as we can and sort of try and increase the upside as much as we can. And by doing this through time, you can enhance the return profile. So that could obviously go into helping even more. But remember what we've done with these scenarios, we said we can either choose to only enhance return or reduce risk. But between those points, we can enhance return and reduce risk. It is very likely that between those points, we can get that 6% with initial withdrawal ruin probability even lower. And if we can get that sub 10 over 35 years, we're very happy. If we can get that sub 5, then tactical tilts through time will definitely bring that number even lower. So, adding investments can really widen your reasonable withdrawal range for a client. And I think that's important. Now, onto parameter tuning. The process we've discussed can be very sensitive to the parameters we chose. So as I mentioned before, adjusting the parameters in a retirement plan can result in very different expected outcomes for clients. So it's important to run through the process multiple times, adjusting parameters to better match the goals of the decumulation portfolio. And another thing to mention is that the techniques we used here are a small subset of those we use when building portfolios for clients withdrawing retirement income. For one, we're an outcomes-based manager. We construct multi-objective portfolios that account for many risk and return metrics that go beyond the discussion we just had. For one, the simulation techniques here that we used here are novel and don't necessarily fully account for tail risk. So what we often do is incorporate more sophisticated simulation techniques to better measure the expected drawdowns and ruin probabilities of various portfolios. Even though what I've presented here is somewhat of an oversimplification, it certainly highlights the important considerations that go into building a robust living annuity portfolio. And the inclusion of alternative investment strategies like hedge funds, I believe, is one of them.
Wiehan, maybe a question, and I think this is something that a lot of advisors often battle with, and I think it is because of the end clients asking these questions, like the end client wanting to take more offshore, wanting to diversify their portfolios, wanting more growth. And then in a sense, not necessarily just the end client, the advisor might have a certain risk mindset where they believe that you have to take more growth assets, you have to take on more offshore within a portfolio. Without going into a conversation of the optimal asset allocation mixes, etc. What's your viewpoint and some of the findings perhaps in terms of offshore and, is there like a clear-cut answer saying that you need to have more offshore if you want to have, let's say, a high withdrawal rate, for instance?
We don't think so, and there's a reason we say that, right? So what we've done is we've gone and modeled that. Let's assume we're talking foreign growth assets. Let's assume we're talking MSCI World. Okay.
Yes.
What we've done is we've built a factor model that decomposes returns into multiple different premiums, right? So you have income, a repricing from your valuation. So where do you buy it at, right? And then earnings and currency, of course. And what we find is that in the very long run, your income is obviously a very small proportion of your cumulative return. If it's compounded, it can be about 10-15% of your long-term contribution to return. Okay. The longer the period, the less valuations matter. And what I mean is that, if you buy MSCI at a 2 sigma valuation, in the next 10 years, your returns will probably be dismal. But in the next 25, they would probably be generally what you'd expect in the very long run. Okay, so in the very long run, the factor contribution from valuations, drops to near zero. The two main contributors to returns are earnings and then the currency for South African investors, right? And now what we find is that they're very, very similar, those contributions through time, but the earnings factor, the contribution to return from the earnings factor increases through time very steadily. So what we find is that that premium is more of an alpha factor, whereas the currency can be very lumpy, right? It could be very large over 5 years, maybe a bit smaller over 10, very large over 20. It's not very stable through time. So the idea is that a lot of investors think that taking your money offshore into foreign growth assets will give you that currency premium. And I think that's when if you went and modeled portfolios through time, that's what you will find happened. But let's now assume that you rather wanted to harvest the earnings premium, right? What we do is we take a quality tilt. So quality companies are those that have very sustainable earnings growth, very low volatility in that earnings growth through time. And that means that they can harness this earnings factor better than the aggregate market. And what we find is by taking that quality tilt, our models, our portfolio optimization models actually say we can take a little bit less foreign equity exposure if we take a quality style tilt through time. So really what I want to qualify here is that yes, you certainly need a good portion in offshore, especially as your initial withdrawal rate rises. But it's not to say that it's a one-stop shop or one specific kind of allocation is going to get you there. Depending on your style tilts through time, your style factors, as well as your tactical allocations through time, those will really matter in the very long run when it comes to your ruin probabilities. All right. The portfolio in and of itself should be relatively dynamic, diversified but dynamic, so that you don't need to take too much currency exposure or beta, and rather try and harness some fundamental factor premium like earnings through time.
Wiehan, thank you. Thank you for taking us through the research that you've done and some of the findings. And I would like to tell our audience again that, we have been busy with the research. Well, the investment team has surely been busy with researching all these aspects of how to perhaps optimally construct a decumulating portfolio. And for time being, the balanced income is still very much suitable for exactly that type of scenario. The balanced income might undergo some changes as we obviously get new research and or do new research and include perhaps even hedge funds. That's exactly why we had this discussion today of potentially including hedge funds in that space. And then also there's an article that will be in the Blue Chip, which was, I think, co-written by myself and Wiehan and then Marius, our CEO, which will most probably be in the August publication, which also talks to some of the points that Wiehan has highlighted today in terms of sequence risk, longevity, and ruin probability. But Wiehan, thank you very much for sharing this with us today. And for everyone on the call, thank you again for attending another monthly webinar. And this webinar will, as always, be on our YouTube channel if you'd like to revisit it or share it with any of your colleagues. Thank you so much and goodbye.